Good morning and welcome back to Almus Market Mornings. We start the week and it's giving me a deja vu vibes, only because it feels like this story has been repeating for the last several weeks. There's some tweet by President Trump which claims upcoming peace, which is followed by escalatory threats, and the week starts in a risk-off mode again. The Iranians themselves have realized it, but the core truth is that the war doesn't show signs of de-escalating. Domestically, Indian rupee on Thursday diverged from moves in dollar index for a change. This time, rupee appreciated despite dollar index also growing stronger. This, of course, is due to the new directives by RBI, which we discussed on Thursday. Good morning, JK. I think the question on everyone's mind is what's next, not just geopolitically, but also for the rupee. Are we seeing some more juice left for it to appreciate?
Good morning, Swaraj. Yeah, I think there are quite a few reaction from the rupee for the set of regulations that we have seen from RBI. I think we had two separate sets of regulations that came one after another, and the second one was more a result of the reaction from the market to the initial regulations to the banks. So we'll definitely deal with the trend later. First, to start with, we have had this weekend tweets from President Trump, and he has said that there is 48 hours left to comply his or comply with freeing the Hormuz Strait by Iran. This 48 hours is out of the 10-day deadline that he had given to Iran. Otherwise, there will be total attack on Iran's infrastructure, which he has threatened. At the same time, he has also said that Iran is negotiating and that the deal will happen on Monday. On the contrary, Iran has claimed drowning quite a few fighter planes of US and it's not really commented anything about negotiations. So the world is just watching the mixed statements and pushed into a huge state of uncertainty whether we're going to re-escalate or we're going to be de-escalate. That is the mind. But today being Easter Monday, most of the markets are closed. Of course, US will be open, Japan is open, India is open. But major markets like Europe and London, they are closed. So market would take its time to assess what's going to happen. Anyway, the deadline is also expiring tomorrow. So we will watch. But I think instead of, reacting to the statements which keep changing every hour, market is most likely watching what's happening to the oil. And oil is a correct reflection of what is going on. And any re-escalation will see oil go above 120, and accordingly the rest of the markets will also move. And if there is a de-escalation, we could see the oil sustainably fall below 100, and then that could be a signal for markets to heave a sigh of relief. So that is what I am watching, and it is very difficult sometimes even to authenticate the kind of statements that we get from various media. So continue to watch oil. In the meantime, we have had, which perhaps the market was not even noticing in the midst of the war news. There was an employment monthly employment data from the Bureau of Labor Statistics from the US on Friday. While it was a holiday all over the world, US was working, and the government data showed that the non-farm payroll increased by 178,000 in March versus 60,000 that was expected. But the previous month's number, which was negative 92,000, was further revised to negative 133,000. So if you look at the number overall, for the 2 months together, we have had an increase of 45,000, which means around 22,000 per month on an average in the last 2 months. So, which is a big, sizable drop from the average that we have seen in 2025, which was around 170,000. So nothing to rave about the higher number of 178,000. Unemployment rate was 4.3 versus 4.4. Once again, not only is 4.3 higher than what we have been seeing over 2025 and even before, but it is also because of the lower participation rate So the participation rate indicates the people who are not seeking jobs are not included as unemployed. So the participation rate includes it hides actually the people number of people unemployed. The wages, of course, eased, which means there is less negotiating power with the employees. Overall, I think, and the year-on-year wages dropped from 3.8 to 3.5, and 3.5 is last seen in May 2021. So overall, I would look at this as a soft number. Forgetting the high non-farm payroll number, this has also followed the job openings. As per Jobs data, that was much lower. Quits rates were lower as well. Rates lowering means more people are keen to hold on to their jobs. Job cuts were higher. Manufacturing, ISM manufacturing also showed the employment dropping. So overall, there is a softening picture in the employment situation in the US, and this probably would have got more attention from Fed if there was no fear about higher inflation due to the war-related rise in oil prices. So we are watching the Fed's reaction to these numbers, along with what happened to the oil price. But definitely, the economy is showing signs of a soft employment situation, which is continuing. And in my view, at some point, this is going to affect the consumption as well, particularly if the gasoline prices remain high as it is now at $4 from around 3.2, which was ruling before the war. Now, on the markets, we have seen yields higher. Today, Japanese 10-year yield has hit a 29-year high. And that is again indication of the kind of inflationary impact of the oil. Japan is fully dependent upon imported oil. And I'm sure there will be similar reaction in the other markets too. Of course, Europe is closed, but US yields are set to open higher as well, so long as the oil remain higher. As far as the dollar is concerned, once again, we have seen last week a failure at 100.50 and above. Market is really struggling for dollar to make headway despite all the demand for safe haven status of the dollar, and despite the rise in US yields, which would have normally attracted more money into the US. Definitely, there's long-term play here, which is keeping the dollar from going higher, because US debt is now about 39 trillion. And there is a rise in fiscal deficit as well. President has proposed 1.5 trillion increase in the military spending as well. So all this is, they don't have any credible solution for addressing these, which is getting worse every month. And this will eventually lead to some sort of a showdown, which in my view will lead to a weaker dollar. That is where the long-term players are reducing their dollar holdings. That is reflected in the dollar index as well. Any strength in the dollar is only due to short-term factors and not on a sustainable basis. Of course, as far as the stock markets are concerned, last week was somewhat of some relief for the market after several statements from Trump, which the market took at face value and reacted positively, particularly in the US. But more, I think markets are looking at two different things. One is the earnings season, which is going to come out with the numbers for Q4 of 2025. In India, also the numbers have started to trickle in. And more particularly for Indian stock market, we have had quite a bit of correction in terms of time as well as the price. From the peak, India is about 13% down, and this is much higher or much more correction than what we have seen in any other market as well. So we now markets are not really that highly valued as perceived by the foreign investors. However, we are still assessing the impact of the Middle East war on the growth and inflation. Perhaps some people still fear a stagflationary situation to hit India as well. So the dollar index remains somewhat offered below 101. But I think it'll take a long time. I think not just the end of the war, but also other structural issues and the monetary policy direction for us to get a real directional move in the dollar. We should be living with a rangy movement for the time being. Now come back to the rupee. Definitely the RBI's directives, particularly the second set of directives, which prohibited banks from offering non-deliverable forward facility to Indian corporates, has had a huge impact. Dollar rupee, just to recall, even after the first set of regulations, which required banks to maintain 100 million or less as the net open position, considering only the domestic position, not offsetting against the NDF position. So that after that, there was an initial setback for the USDNR, but we actually made a new high at 95.21. But this was due to the fact that banks started offering their position, short positions in the NDF to the customers who are looking to sell, that is the exporters, with a higher premium. But immediately RBI's second set of regulations prevented this. And they also said that customers cannot rebook the cancelled contract. This has removed a lot of excess demand from the market, and the forced liquidation from the banks, which has started it saw even 90 to 80 being traded on Thursday, and looks like this pressure will continue on the USD INR. And let's also remember that for quite some time now, USD INR has been trading one-sided. The hedging has been also one-sided. Importers have been more active than export. Exporters are mostly taking cash rates. They are not booking much of forward, hedges as well. Now with this forced selling, we'll have to wait and see really if the market has the appetite to absorb the kind of number or the kind of long position that market is talking about, close to 20 billion or more. Part of it might have got absorbed for now, but not a major portion. So I think in the run up to the 10th April deadline, by when the banks have to liquidate their excess long position, we could see more impact on the USD. I wouldn't be surprised to see 92 also in this run. But along with that, if we do have a de-escalation, but that is very optimistic statement. If we do see a de-escalation, we could see more impact on the downside to the USD INR, which will not be surprising. So we are looking at some strength near term in the INR, more strength. 93, 50, 60 should be a cap for the time being. Downside being open depending upon how the liquidation goes and how the news flow from the war also comes about. So we are into the new year, new financial year, and one thing to recall is that every month of 2026, in the beginning, we have seen some big developments. January started with the Venezuela crisis, or rather the annexation of Venezuelan ruler by the US, and then in February we saw the trade deal between India and US, which had given a big relief to the Indian economy. And then, of course, it was followed by a negative news in March beginning, as US-Israel attacked Iran, and that war is still continuing. Now, as we step into April, because the global markets are going to be for the first time active, from tomorrow, whether we see any new development, positive or negative, which the market will be looking out for. Thank you.
Thank you, Jake. And yeah, so everybody would be looking for any signs of de-escalation. Of course, there's a talk on the 48 hours left for Iran to comply with President Trump's demands freeing the Strait of Hormuz. Yeah, of course, if that doesn't happen, there are claims that Iranian civilian infrastructure will be hit significantly. So yeah, markets are in a wait and watch. Oil prices are comfortably trading over $100, and of course, the higher energy prices are impacting a lot of Asian countries which are so import dependent, including Japan. Japanese yields are reflecting that the 10-year yield has hit 29-year high, and this would be the case similar to all energy importing countries. Dollar index is broadly struggling to make headway above 100.5 despite all this major safe haven buying. Domestically, when we come back to rupee, The RBI's second set of derivatives, which prohibited banks from offering NDF products to corporates, has resulted in a lot of unwind of the positions with respect to the earlier circular, which limited banks' arbitrage positions in the onshore market to $100 million. There's a deadline of 10th April for the banks to unwind this. Until then, there could be a pressure on the dollar against the rupee, basically of a lower USD INR, and a test of rupees 92 is possible because these are large positions, and we are already seeing a lot of things disrupted in the ongoing workings. So we'll wait and watch, but there is possibility of rupee appreciating more. That's it from us today. Thank you for listening. We will catch up tomorrow with a fresh round of updates.